The classic textbook story of banking is straightforward. You deposit $1,000, the bank locks a fraction in reserve and lends the rest. That money lands in another bank, which keeps 90 and lends 800. On it ripples, redeposited in smaller fractions. This model is tidy, intuitive, and is what most students are taught as the money multiplier. Yet, there is a foundational problem. Central banks have recently stated that this widely accepted textbook model doesn't actually describe how they operate. In 2014, the Bank of England published a report stating that commercial banks do not act as intermediaries, nor do they lend out existing savings. To understand why, consider the scale of what we actually spend. Physical cash makes up only a tiny sliver of the economy. The overwhelming majority of our money exists purely as digital deposits. If banks are not moving existing cash from a vault, and most of the money supply is just numbers on a screen, where do those numbers actually come from when you sign for a loan? An economist named Richard Werner realized this had never been empirically tested. In 2014, he conducted the first study of its kind to track the exact origin of a new digital dollar. Werner arranged to borrow a sum of money while securing permission to monitor the cooperating bank's internal ledger in real time as the loan processed. When the loan was issued, the ledger showed no funds transferring from a vault, a central reserve, or another customer's account. The bank simply typed brand new numbers into existence. The lending comes first, and the deposit is what the loan creates. If a bank can create money with a keystroke, it raises an immediate question. What prevents them from creating infinite money and triggering runaway inflation? While textbooks often point to reserve requirements as the limit, the United States Federal Reserve cut mandatory reserve floors to 0% in March 2020. Since literal reserves are not the primary brake on money creation, the modern economy relies on 4 specific mechanical governors. The very first governor is profit risk. Because every loan is a bet on repayment, reckless lending leads directly to defaults that can destroy a bank. The second governor is capital requirements. Watch the expanding new loans bar consume the equity cushion. Banks legally must fund lending with their own equity. Once this cushion runs thin, they must stop lending, regardless of willing borrowers. The third major governor is consumer demand. Credit requires a two-sided handshake. If businesses and individuals are too worried about the economy to borrow, banks cannot conjure new money into the system. The fourth governor is the central bank. They manage the volume of money by setting interest rates, which dictates the price of borrowing. The central bank does not ration out a fixed pile of cash. They turn the interest rate dial to make the creation of new money either cheap and tempting or expensive and slow. If signing a loan brings new money into existence, it creates a second, equally important reality. What happens when that loan is paid off? Repaying a loan does not return money to a vault. In a system of double-entry bookkeeping, paying down debt literally extinguishes the digital deposit from existence. This means the money supply is a breathing entity. As this visualization shows, new particles are injected during loan origination, and they evaporate completely during repayment. The supply swells as credit expands and shrinks as credit contracts. Our money is not a fixed pool of currency. It is a number tied to the life cycle of debt. This mechanism explains why trillions of dollars in spending power seemed to simply vanish during the 2008 financial crisis. Old loans were being defaulted on or paid down much faster than banks were writing new ones. As credit ceased, the money supply physically evaporated from the economy. This same logic applies to inflation. Prices climb when the river of new credit surges faster than the supply of real-world goods and services. By watching the flow of credit rather than the myth of a fixed money supply, the headlines about interest rates, debt, and recessions finally become readable.